All right, so a lot of people are asking, what's the return on the investment with this? So what I'm doing is I'm taking the value of the property, right? And I'm breaking it up into little bit increments at $50 a piece. So what that means is, it's like you're investing in a regular rental property. If you buy a regular rental property that's $120,000, and you're in a good market and you get good cash flow, which is about $400 a month, that's $4,800 a year. That's a 4% return on that $120,000 investment. So with this, what you're doing is you're buying a single share and you're gonna get between 3% and 5% on the dividend, which is the exact same as owning a rental property. Because if you were only getting $300 a month on that rental property, you'd be making 3%. If you were making $500 a month, then you'd get about 5%, okay? So now you can take $250 and it's like buying a micro investment. You know, it's like buying a micro rental property. But the real value here is the property itself, because it's in a gentrifying area and the property value is gonna shoot up. So imagine owning a rental property in a market where the value was 120 and in a few years it's gonna be worth 180 or 200,000. That's where the value is here. That's what we're doing. So I'm taking an opportunity that usually would not be available to you and allowing you to buy a small portion of a really big pot, up to $10,000, which is 200 shares, okay? How do you get out of that? Well, once a year, the company will offer to buy back shares. And when we buy them back, they will be at the new valuation of the property. So we're gonna have a soft appraisal done on it. And once we know what it's worth, then we'll say, okay, the shares went up $5 a share. So now we'll buy them back at $5 a share. And then we'll keep some, or if other investors that are still in and wanna buy more, they can buy more, they can double down. So that's how it's gonna work, guys. And the dividend, the 3 to 5% is determined by me saying, okay, I'm gonna take the net profits after we pay all the expenses, and I'm gonna distribute 40% of them to all the shareholders. I'm gonna divide it up by the total number of shares, and I'm gonna send it out like that, okay? The other 60% of the net profit, a lot of it is gonna go back into reinvesting into the property, making the commercial space better, okay? Because as we add value on the commercial side, as we add rental revenue on the commercial side, we add value. And value is greater on the commercial side because it's not based off of comparable sales like a house here, a house there. It's solely based off of the revenue, and it's a multiple of the revenue, okay? It's called a cap rate, which is a return on investment. So for an example, for a cap rate, a standard cap rate for a mid-grade property, let's say it's 10%, okay? If it's 10% and the property brings in $100,000 a year, someone is willing to pay $1 million for it because they know that they will make $100,000 every year. That's 10%. Now, if it's grade A property, like class A, very nice property, that cap rate maybe only be 5%. So they only want a 5% return. So for that same property that's bringing $100,000 a year, somebody will be willing to pay $2 million for it because they only want a 5% return. And a 5% return on $2 million is $100,000. So we will be building a class A property. Even though it'll be small class A property, it'll have a high cap rate, and that's gonna make everybody's shares go up in value. So a lot of people are asking about cash flow. You know, what are the dividends? Don't focus on the dividends in this. The big money is made in owning the real estate itself. Hopefully that helps.